Welcome to part 2 of Understanding the Balance Sheet with me, John Bone. Okay, we're still in our learning outcome that is asking us to distinguish between current and non-current assets and liabilities and to describe the types and measurement bases. We're turning our attention now to financial assets and liabilities. So let's have a look at our list. So we're talking about stocks, in other words, equity. So we're talking about common stock, we're talking about preferred stock, in other words, common shares and preferred shares. We're talking about bonds, so debt instruments that are sold to investors. Receivables, amounts that are owed to the company, essentially. Notes receivable, these are short-term interest-bearing assets. Notes payable, short-term interest-bearing liabilities. Loans from banks, essentially. And also derivative investments. So within derivatives, we're really talking about futures, forwards, options and swaps. So first of all, let's have a look at the ones that are recorded at fair value. So this means we're marking them to market in the balance sheet. And of course, if we haven't sold them, if we increase or decrease their value, that's going to generate unrealized gains and losses. So two of our passively held investments there, trading securities. Trading security is a security that is held purely for its investment value with the intention of selling in the short to medium term. Available for sale securities, again, these may be sold for liquidity purposes. Both of those are going to be recorded at fair value. Derivatives, so any of our derivative products are going to be recorded at fair value. Whether they're standalone derivatives, naked derivatives used for speculative purposes, or whether they're embedded in a non-derivative instrument. So for example, a callable bond is essentially a bond with an embedded call feature on the company's equity. Notice as well, if we're using derivatives for hedging purposes, so we're trying to hedge the value of an asset or a liability, well, if we're going to mark to market the derivative, we also have to mark to market the asset or liability. So both the derivative and the asset or liability that it's hedging is recorded at fair value. And the purpose for that, of course, is any gain or loss on the derivative should offset any gain or loss on the underlying asset. So both must be recorded at fair value. Financial liabilities, well, again, we've got our derivatives and also non-derivative investments that are being hedged using derivatives. Same reason, of course, for that as our assets. Any gain or loss on the underlying liability should be offset by a gain or loss on the derivative. So both must be recorded at fair value. Let's have a look at assets and liabilities that are held at cost. In other words, purchase price or amortized cost. So under US GAAP, unlisted equity securities are held at purchase price. Held to maturity investments. Now these are passively held debt instruments, okay. We're going to look at their treatment in a little while, but these are going to be actually held at amortized cost. What does amortized cost actually mean? Well, it means initially they go in at purchase price, but we're then going to amortize any discount or premium compared to par value over the life of the security. What that means essentially is if you bought the bond at a discount to its par value, its asset value will slowly increase to par over its life. If you bought a bond at a premium, then that premium is going to be amortized, so the carrying value of the asset in the balance sheet declines to par over time. Now, I don't want you to get too worried about amortization right now. We are going to look at it in detail in a later reading when we look at how bonds are accounted for that the company is actually issued, and we'll actually get into the mathematics behind amortizing premiums and discounts. Bank loans are typically held at cost, and receivables, we said things like our trade receivables, our accounts receivables, are held at their net realizable value. So what the customer owes us net of any bad debt provision. Financial liabilities, bonds, notes payable, etc. are all going to be held at either cost or amortized cost as well. And as I said, we're going to look at the situation where a company issues bonds and how they're accounted for in a later reading. Let's turn our attention to our marketable securities. These are passively held investments. Passively held investments, there are 3 classifications here. Now notice the classification is based on the company's intent with regard to eventual sale. And we're going to see that there are 3 classifications. Held to maturity only applies to debt securities. Remember, equity is essentially perpetual. It doesn't have a maturity date. So this has to apply to debt securities. But it only applies to debt securities where we have both the intent and ability to hold to maturity. So we're going to see held to maturity applying to debt. We're going to see available for sale or trading securities applying to both debt and equity. Let's turn our attention to held to maturity. So as we said, the company has to intend to hold to maturity. So they have to have both the intent and the ability. There are penalties referred to as tainting if you dispose of held to maturity securities prior essentially to their maturity date. The securities are carried at cost in the balance sheet. Now again, remember that's strictly amortized cost. We're going to amortize premiums and discounts on held to maturity securities. In the income statement, we're going to see realized gains and losses on disposal and any income. Now, of course, the income on bonds will be the interest essentially on the bond. Realized gains and losses would be any gain or loss that's generated if we dispose prior to maturity. Now, caveat, remember, we're meant to have the intent and ability to hold to maturity. If you do dispose prior to maturity, then you're deemed to have tainted your held to maturity. What that simply means is you can't use this classification going forward, and any remaining securities have to be transferred out of held to maturity and put into one of the other classifications, i.e. available for sale or trading. Available for sale securities, they may be sold to satisfy company needs. In other words, they may be sold for liquidity purposes. The kind of definition here is they're not held to maturity and they're not trading securities, so it's really a catch-all for anything that we have left. Now, it applies to both debt and equity securities. They could be either current assets, probably most likely to be current assets, but strictly speaking, they could be non-current assets as well. Now, we're going to carry in the balance sheet at fair market value. Now, what that means, of course, is we're marking to market. So if fair market value increases, we're going to record the balance sheet value at the fair market value at that balance sheet date. Now, of course, if fair market value is increased, that's going to generate unrealized gains and losses. Now, if fair market value is increased, it's going to create an unrealized gain. If fair market value is decreased, it's going to create an unrealized loss. Where do we take these unrealized gains and losses? You can't simply just increase the asset to its fair market value without adjusting something else in the balance sheet, or the balance sheet won't balance. Well, we've got a choice, really. Either we could take to the income statement or we could take direct to equity. And that's going to be the essential difference between a trading security and available for sale, where the unrealized gains actually end up. Under available for sale, we're going to take the unrealized gains each period and take them directly into stockholders' equity within that other comprehensive income element that we mentioned earlier. Now, when we look at other comprehensive income in stockholders' equity, we're going to see the cumulative unrealized gains or losses so far on that security. This year's unrealized gain or loss would be the change in the OCI items, the change in the other comprehensive income item. So in other words, it's a cumulative figure in stockholders' equity. It's going to increase each year by that year's unrealized gain. It's going to decrease if that year we have an unrealized loss. Notice it says the income statement is the same as the held to maturity method. In other words, we'd be seeing interest going through the income statement if it was a bond. We'd be seeing dividends going through if it's equity, and we'd be seeing realized gains and losses on physical disposal of the security. Now, trading security, our last classification of our marketable securities. These are speculatively held investments that have been acquired with the purpose of selling in the near term, hopefully, of course, to generate capital gains. So they're going to go into the balance sheet. They're going to be treated as current assets because, remember, they've been acquired for the purpose of selling in the near term. Okay, so they're not going to meet a definition of a long-term asset, a long-lived asset here. So they're going to be in current assets and they're recorded at their fair value, their market value. So again, as fair value changes, we're going to get unrealized gains and losses on these securities. Where do they go? Well, available for sale said take directly to equity, do not go via the income statement. The difference with trading securities is that we do take the unrealized gains and losses into the income statement. Now, of course, the balance sheet will still balance if we do that because it means net income would be essentially higher if we've got unrealized gains and therefore retained earnings would be higher. Okay, but the idea here is the unrealized gains and losses are not going directly into other comprehensive income within stockholders' equity. They're going via the income statement into your earnings for the year and therefore affecting retained earnings. So carried in the balance sheet at fair value, unrealized gains and losses to the income statement. So notice when we look at the income statement, we're going to see dividends, we're going to see interest if it's debt, we're going to see realized gains and losses on disposal, but we're also going to see the unrealized gains and losses, fair value adjustments for securities that we haven't disposed of at year end, hitting our income statement. So let's have a look at an example. Now note our LOS is described, so we shouldn't actually be seeing numbers in the exam, but hopefully this will illustrate the points that we've been talking about. Ellerslie purchased 35% annual pay $1,000 face value bonds. Now we've kept them at par value. Notice the purchase price $1,000 par value. This is to eliminate, there's no discount or premium to par, to keep this example nice and simple for you. When we move to level 2 exam, we'll see what actually happens when you've got investments that have been purchased above or below par value. We'll see that amortization. So we purchased 35% annual paying, so annual coupon bonds with $1,000 face value, and we bought them on the 1st of January 20x4. The market price of the bonds on the 31st of December X4, so 1 year later, was 1,010. So each bond has got a $10 gain, if you like. Now, if we haven't sold them at year end, remember that means that $10 gain will be an unrealized gain. The interest on the bonds, well, let's take our 30 bonds times the coupon rate of 5% times their par value, and notice therefore we get $1,500 for that. And that was paid during the year. So under all three methods, we're going to see the interest on bonds hitting our income statement. So we're asked what are the balance sheet and income statement entries, and we're going to look at the three methods: held to maturity, available for sale, and trading securities. Okay, now the treatment of interest, as we mentioned, the 1,500 will be reported as income under all three methods. So that's going to hit the income statement during the year 20x4 in the income statement under all three classifications. Now let's have a look at our unrealized gain or loss. $10 per bond, the difference between the year-end fair value, $1,010, and the difference between the original purchase price, or the value at the start of the year, if you like, $1,000. So we've got a $10 unrealized gain generated during the year per bond, 30 bonds, so that gives us a $300 unrealized gain. Now, if we treat that as a trading security, we're going to record the bonds at $1,010 each in our assets, and we're going to take that $300 unrealized gain and we're going to take it into the income statement. It's going to hit the income statement, meaning our net income is $300 higher, and therefore our retained earnings are $300 higher. If you like, our asset value is increased by $300, $10 per bond, 30 bonds, so the asset value's gone up by $300. Stockholders' equity goes up by $300, and it goes up via retained earnings because that $300 has hit the income statement. Now, available for sale, again, we're going to record the asset at the fair market value. So the asset's going to increase by $300 in our assets. The difference is, where does the counterbalancing item go? Where do these unrealized gains and losses go? Here, we're taking directly into stockholders' equity in these other comprehensive income items. So it's going to go into other comprehensive income items. So essentially, assets have gone up by $300. Stockholders' equity, in this case, has gone up by $300, and everything still balances. The key point to note, though, is those unrealized gains and losses have not gone into the income statement. Held to maturity. Now, the key point with held to maturity is fair value is not being represented on the balance sheet. What we're going to see is the asset being recorded at amortized cost. Now, as we said, amortization refers to premiums on discounts compared to par. Note in our example, we purchased at par value, so we can really put that issue to a side here. So there is no, if you like, amortization of premiums and discounts in our example. So in the balance sheet, we're going to report here at amortized cost. That will be the same as purchase price in this case due to the absence of discounts and premiums. And we're going to show the interest in the income statement. And that's it. Fair value is not represented. It's not shown essentially anywhere in the financial statements. Well, I say it's not shown anywhere in the financial statements. It's often reported in the footnotes, but it's not going to be reported in the balance sheet or income statement. Note that equity securities cannot be classified as held to maturity. Well, we've stated this already. Held to maturity only applies to debt securities, and remember, you have to have both the intent and ability to hold to maturity. So let's have a look at our summary here. Dividends, interest, realized gains and losses always appear in the income statement. Remember, our definition of a realized gain or loss is the gain or loss arising on the disposal of the securities. Unrealized gains and losses are only going to hit the income statement for trading securities. Unrealized gains and losses, remember, under available for sale go direct to equity, and unrealized gains and losses are not reported for held to maturity because we don't make any fair market value adjustments. Now notice therefore unrealized gains and losses are reflected on the balance sheet for both trading and available for sale securities. Now again, that's really simply saying, look, we adjust the asset to fair value. It's where the unrealized gains and losses actually go. Remember, equity for available for sale, income statement for trading. But remember, if it affects the income statement, by default, it affects stockholders' equity within the balance sheet via retained earnings. So, unrealized gains and losses on available for sale securities show up, remember, in comprehensive income. They do not show up in the income statement. And this is a very controversial area, and it's certainly been a very controversial area during the credit crunch 2008, 2009, because if you had trading securities, or securities classified as trading, and the loss of liquidity in the markets caused massive downward values of your assets, you would be reporting massive unrealized losses through your income statement that would have affected your earnings. Whereas if you treated them as available for sale, those unrealized losses avoided recognition in the income statement and went direct to equity, and if it was held to maturity, you didn't show them anywhere. So it became a very controversial area in 2008, 2009, and the accounting standards boards were put under some pressure by financial firms to actually change the accounting. They didn't actually buckle to that pressure, but you should be aware of it. Okay, let's turn our attention to current liabilities. Notice you need to be aware of these 4 criteria. And again, key fact here, it's any of the 4 criteria, not all of the 4 criteria that need to be met. So number 1, it's expected to be settled in the entity's normal operating cycle. Remember, that's the length of time between receiving raw materials and essentially receiving the cash from your customer from selling a finished good. Held primarily for the purpose of being traded, it's due to be settled within 12 months from the balance sheet date. And that's the one that I would really focus on and make sure you're clear of. Okay, so typically a current liability is one that's going to be settled within 12 months. And notice point 4 is just saying, therefore we cannot defer settlement for greater than 12 months. If we could, it would be a long-term liability. All other liabilities are deemed to be non-current, sometimes referred to as long-term liabilities. So be aware of your 4 criteria, but certainly criteria 3 is probably the most important to keep in your mind. So let's have a look at some current liabilities. Accounts payable and trade payables. Well, you know, these are the same thing, different terminology. Accounts payable, trade payable, amounts that you owe to your suppliers at the balance sheet date. You bought goods and services on credit, but you haven't paid the supplier at the balance sheet date. Notes payable, short-term interest-bearing borrowings, current portion of long-term debt. Now, imagine that you had a bond that had years to maturity. For 9 years of its life, it's going to be sitting in long-term liabilities. In the final year, it suddenly got less than 12 months to maturity, and therefore it will be shown in current liabilities. As well, with long-term debt, if we have finance leases, these are assets that we lease in under a finance rather than operating lease. Again, we'll talk about that in a reading later on. Again, you will see next year's principal payment sitting in current liabilities, principal payments falling due for after more than 1 year, sitting in long-term liabilities. Accrued liabilities, we've mentioned this already. You've used a good or service, you haven't received the invoice, but you do need to show the expense in the income statement, and you create a counterbalancing liability in the balance sheet. Taxes payable, so amounts owed to the tax authorities for this year's tax, essentially. And unearned revenue, customers paid you, but you haven't met the criteria for recording a sale yet, so you record a liability instead. Now let's turn our attention to components of equity. So this is our stockholders' equity, and remember, assets equals liabilities plus equity, or assets minus liabilities equals stockholders' equity. Now, when we look at our equity, first of all, we see the contributed capital. And there's 2 elements of contributed capital, and that is the common stock at par and additional paid-in capital. Remember, let's imagine par value is $1, you issue a share, the company issues a share, for $1.50. Then, of course, $1 goes into common stock, 50 cents goes into additional paid-in capital. Additional paid-in capital often referred to as the share premium account. Now, when we look in the balance sheet, we're actually going to see the issued share capital, how many shares the company has actually issued, and we're seeing the cash raised when those shares were issued. Subsequent changes to market value in equity are not reported in the balance sheet. That, if you like, is a problem for the investors, not the company. But we'll also see a note telling us the authorized share capital. This is the total amount of shares that the company can issue. Now, if it wants to issue more shares than its authorized share capital, it will need to go back to the shareholders and get them to vote to increase the authorized level. Preferred stock, irredeemable preferred stock, so preference shares that have no redemption date. Now, in that situation, they go into stockholders' equity. If you've got preference shares that are redeemable, have a fixed length of life, then we're saying, look, they're more like bonds than equity, and therefore we treat them as a debt security rather than as a component of equity. If you think about it, redeemable preferred stock, you're receiving a fixed dividend, just like a bond receives a fixed coupon. They don't have any voting rights, and it's got a fixed life. It's a bond if it's redeemable, essentially. It's just got a legally a different name. So irredeemable, though, they're saying, no, look, it's not like a bond because it doesn't have any redemption date, so it's treated as part of equity. Treasury stock, this is where the company has bought back shares in itself. Now, if a company buys shares in itself, they go into the balance sheet as a negative balance in stockholders' equity. Notice it reduces equity, but then the company can reissue those shares at a later date. Now, treasury stock, whilst the company owns those shares, they lose their voting rights. I mean, it makes no sense for the company to be able to vote on company matters, so they lose their voting rights, and they also lose their dividend rights whilst the company holds them. Retained earnings, remember, is our key linkage between the income statement and the balance sheet. It's the cumulative amount of undistributed profits for the company. Remember, every year we generate that year's net income. We may choose to pay out a dividend, and anything left over gets added to retained earnings. Non-controlling or minority interest, again, only going to see these in group accounts, and it's only when essentially we've acquired less than 100% of the share capital of a subsidiary. And remember, it's caused by the fact that when we produce a set of group accounts, we bring in 100% of our subsidiaries' assets and liabilities. And of course, if we own less than 100% of the share capital, that means we're bringing in assets and liabilities that don't belong to our shareholders. Now, this is because group accounts reflect the assets and liabilities that you control, not necessarily the assets and liabilities that you own. Now, what that means is we show the net assets that were included in our balance sheet that didn't belong to our shareholders in stockholders' equity, and it gets the name minority interest or non-controlling interest. Again, we're going to see a lot more of that in the Level 2 syllabus. And then our accumulated other comprehensive income items are going to be in stockholders' equity, such as the unrealized gains and losses on available for sale securities that we've just discussed. Now, here is the primary financial statement, the statement of changes in stockholders' equity. If you remember, this statement of changes in stockholders' equity reconciles opening and closing stockholders' equity. Now, you can see when we have a quick look at this, we've got our common stock at the start of the year. We've got the common stock at the end of the year. In other words, the beginning balance is in last year's balance sheet, and the ending balance is in this year's balance sheet. And you can see, therefore, the changes. This company has issued $1,282 of common stock and repurchased $6,200. So you're seeing new issues and buybacks in that column. We've then got our retained earnings. Now, remember, here is the beginning balance representing the cumulative earnings that haven't been distributed in past years. It's then going to go up by this year's net income, and it goes down by this year's dividend. So the ending balance, the cumulative earnings that haven't been distributed by the end of the year. Now, our third column here is those OCI items, the other comprehensive income items. Let's have a look at what we've got. So you've got, notice, an amount brought forward. Remember, these are cumulative. Figures in the balance sheet are cumulative. They build year on year, unlike the income statement that resets to zero at the start of each year. So the beginning balance, notice it's negative here, meaning they've got overall losses on their other comprehensive income items coming forward at the start of the year. Then we've got this year's elements. So notice our available for sale securities, we generated a 40 loss here. So that's going in, there it is. Notice we've got unrealized losses on cash flow hedges, 56. An adjustment to pensions, remeasurement adjustment to pensions. Again, don't want you to get too worried about that in the Level 1 syllabus. Just be aware that if you do have defined benefit pensions, there is an impact in stockholders' equity via other comprehensive income. We'll get into the detailed mechanics at Level 2. And we've got a cumulative translation adjustment. This is positive, a gain, therefore, of 42. The cumulative translation adjustment being resulting from converting subsidiaries into our parent currency, overseas subsidiaries into our parent currency at the balance sheet date. Again, a lot more detail of that in the level 2 syllabus. Okay, so that gives us the cumulative other comprehensive losses in this case at the year end. And then of course the final column is just simply totaling it up. So therefore we had stockholders' equity of 75,492 at the start of the year, and at the end of the year 75,128. So certainly be aware of your statement of stockholders' equity. A reconciliation simply of opening and closing stockholders' equity, explaining exactly why it changed. Now, our next LOS asks us to convert a balance sheet from absolute monetary terms into relative common size terms. So we've got to be able to convert and interpret what we've done. Now, we looked at common size statements earlier when we looked at the income statement. In the income statement, each line in the income statement was shown as a percentage of sales or net sales. In the balance sheet, each line in the balance sheet is going to be shown as a percentage of total assets. So PP&E would be shown as a percentage of total assets, inventory as a percentage of total assets as well. Now remember the purpose of doing this. It's converting from absolute monetary amounts into relative percentages, and that gives us the ability to compare firms of differing sizes. And of course it does help us with trend analysis, looking at one company over time and looking at how the assets, different types of assets are changing as a percentage of total assets over time. And it allows us cross-sectional analysis where we compare between companies as well. What size is what percentage is, let's say, property, plant and equipment of our firm compared to another firm in our industry. Now we're also asked to calculate and interpret liquidity ratios. We're going to see this here, but we've got a big reading on ratios coming up a little later. So our liquidity ratios, these are all about the ability to meet your current liabilities when they fall due for payment. The current ratio being the most famous, take your current assets, divide by your current liabilities. Now the basic rule is if the current ratio is less than 1, it could indicate a liquidity issue because you haven't got sufficient current assets to pay off your current liabilities. I said could indicate a liquidity issue. Actually, it's a little bit more complicated than that because we need to look at the speed of turnover of current assets and current liabilities as well. So when you look at a lot of supermarkets, for example, they'll have a negative current ratio even though there's no danger of liquidity, and that's because their current assets turn over very, very quickly, but the current liabilities turn over very, very slowly. So in other words, when we're looking at the current ratio, we also need to consider the cash operating cycle that we'll discuss later. The quick ratio is just a reworking of the current ratio. It's going to remove the most illiquid of current assets. And the most illiquid of current assets is our inventory. Why is inventory illiquid? Well, let's imagine we've got some raw materials. You've got your raw materials. First of all, you have to produce the good. Then you have to sell the good. And then finally, you have to collect the cash from the customer. So there could be a big lag between having inventory and actually converting into cash. So all we're doing with the quick ratio, and the quick ratio sometimes gets referred to as the acid test. All we're doing with the quick ratio is reworking the current ratio, excluding the least liquid of our current assets. Now the cash ratio just says, well, let's only look at liquid assets. So it's looking at cash and marketable securities. So any security that's traded on an exchange. Idea being essentially we could phone up our dealer, convert into cash, and the cash would be in our account 1 to 3 business days later, depending on the type of security. Solvency ratios. Now with our solvency ratios, it's really looking at your capital structure. It's looking at the blend of debt to equity, and it's looking therefore at your leverage. Now, the most common ratios we've got here, 2, long-term debt to equity and debt to equity. Long-term debt to equity just looks at our total long-term debt, so excludes any current liabilities, and it puts it over stockholders' equity. Now, when we look at long-term debt, we only pick up on interest-bearing debt. Okay, so any long-term liabilities that don't have any interest implications are excluded. Debt to equity, notice it doesn't say now total long-term debt, it says total debt. This is all interest-bearing liabilities, whether they're long-term liabilities or whether they're current liabilities. So we would need to look at our current liabilities and we would need to pick up on things like notes payable, things like the current portion of long-term debt within them. So debt to equity is really just a ratio of the volume of debt, balance sheet carrying value of debt to the balance sheet carrying value of equity. Total debt looks at debt over assets. Now, of course, theoretically, you could liquidate the assets and use them to pay off liabilities. So really, therefore, we want the assets, the total assets, to be bigger than the total debt. It's a kind of a safety ratio. Financial leverage, total assets over total equity. Now, this is known as financial leverage. Sometimes it's referred to as the financial leverage multiplier. Basic rule is if we were acquiring assets only using equity finance, the ratio should be very close to 1. Once we start to acquire assets with debt finance, the assets will go up, equity will be unaffected, and therefore the ratio will start to climb above 1 as we introduce debt financed assets into the company. We're going to see the financial leverage multiplier again, or financial leverage again, when we look at DuPont analysis.